Welcome, and thank you for watching this video about dividend growth investing. My name is Charlie Toole, and I'm the Director of Portfolio Management, and I oversee our dividend growth strategy at RWA Wealth Partners. What exactly is a dividend, and why do they matter so much to investors? A dividend is simply a payment of a portion of company profits to stockholders by a corporation. And dividends are an important part of the total return that stocks can provide. Let me show you what I mean. This chart goes back 35 years and shows the growth of the S&P 500 with and without dividends. Without dividends, the index has appreciated more than 1,500%, or about 8% per year. But when you include dividends that are reinvested back into the S&P 500, the total return is more than 3,300%, or 11% per year. So the total return, when including dividends, is more than double the return without dividends. And this is why dividends matter so much to investors. One area of dividend investing that we think gets too much focus is dividend yield, the dividend per share divided by the price per share. Many investors put too much emphasis on dividend yield, which is just a measure of valuation, much like the price to earnings or PE ratio. We prefer to focus on the growth of the dividend and look to invest in stocks that grow that dividend year after year. Dividend growth is the most important factor in our strategy's stock selection process. It's a simple, straightforward way to find what I consider to be high-quality companies. Companies that can raise their dividend year after year, have strong business models, that generate free cash flow, that have allowed these companies to historically raise their dividends in good and bad markets. If you just ran a screen for stocks that grew dividends, there would be more than 200 large cap stocks. Our strategy prefers to concentrate the portfolio into the best 30 to 40 ideas. We analyze the universe of dividend growth stocks and focus on companies we consider to be high quality. These include companies that are financially strong, with low levels of debt and battleship balance sheets. Companies that are free cash flow generators with high free cash flow margins, which means that these companies keep more cash from their sales. And they have pricing power. In other words, they're companies that have great products or services that customers will continue to consume even if prices are rising. In addition to dividend growth, we look for companies that grow revenue and profits, because over time, stock prices will follow earnings and free cash flow, higher or lower. If you want to learn more, please call us at 833-RWA-PLAN or visit us online at rwawealth.com. Thank you again for taking some time to learn a little bit about our dividend growth strategy, and have a great day.